Hi there. When we're looking at how businesses ply their trade around the world, we're going to come across a concept called protectionism. So let's just spend a few minutes having a look to see what protectionism is all about. You may have heard of a concept called free trade or open trade. Well, protectionism is the opposite of open trade. It involves attempts by countries using a variety of methods to try to restrict the trade in goods and services coming into an economy. So protectionism, leaving aside the political arguments for protectionism, the main aim is, well, there's a clue in the word, it's to protect domestic businesses, domestic industries from the effects of open trade, of free trade. So let's just take a quick look at the main types of protectionism. There are a variety of methods. You don't need to be an expert in any of them, but it's worth jotting down the main types and how they work. Well, if you've been listening or watching the debate about protectionism and the relationship between the US and China, you would have heard tariffs mentioned many times. Tariffs are perhaps the most common, or one of the most common types of protectionism. It involves a domestic country imposing a tax or a duty on certain imported products and services. And of course, the effect of that is normally to raise the price of those, which in theory causes a fall in demand for those imported products. And an example there of import tariffs that the US impose on bicycle manufacturers wanting to sell into the US. Lots and lots of different tariffs out there, and similarly, there are also many quotas. Now, if a tariff is a tax or duty on the price of a product, a quota is a limit on the quantity, the number or volume of imports of a particular product that is allowed. So it could be, for example, Algeria has a limit on how many cars can be imported into the country each year. So tariffs are all about a tax, quotas are all about a limit on the quantity, but there can also be other types of protectionism. For example, and I think these are increasingly common, so-called non-tariff barriers. For example, a country requiring a particular quality standard for products before they can be imported or served to the domestic audience. It might well be that there are some labelling requirements on the product, or that there are some technical or regulatory hurdles to overcome, all of which try to restrict the import of those goods and services. On the other side, it could be that a domestic government decides to actively promote or support its domestic businesses, one way of which is to provide subsidies to lower the export price, to make hopefully the products of the domestic industry more price competitive in international markets. And more generally, the use of domestic subsidies or state aid for certain businesses is one way of protecting them from overseas competition. When you get into looking at the impact of regulation from areas such as the European Union, it gets quite complicated in terms of state aid because essentially it's not allowed. But nevertheless, as a method of protectionism, governments providing their domestic industries with particular grants, subsidies or other advantages is one tool in the armoury. There we go then. So we've just taken a quick look through there, the different methods of protectionism, and hopefully that's been useful for you.